Hello and welcome to the Cummings Pepperdine hugely popular crypto questions. I'm Claire Cummings from Cummings Pepperdine, and we're an advisory firm based in London, and we work with helping our clients with the three key areas of law, FCA and tax. And in this edition of our hugely popular crypto questions, I'm going to be talking to Ian Gobin of Intertrust Law in Cayman about the main issues that somebody who's setting up a crypto fund needs to bear in mind and how we can solve them. Now, a word of background here. Ian and I have known each other now for about 20 years. I can't tell you what we were both wearing when we met. That's another story. But Ian, hello, tell us about you and about Intertrust.
Thank you, Claire. That's hilarious. We haven't known each other for the best part of 20 years. And the first sort of 10 years of our relationship, we never actually saw each other.
It was so weird when we met. I had to close my eyes.
Anyway, we digress. So today we're here to talk about the issues with what to watch out for when you are setting up a crypto asset fund. As Claire said, I'm Ian Gobin. I'm the global managing partner of Intertrust Law, which is a BVI and Cayman registered law firm.
So Ian, you and I have been working on the structuring and growth of hedge funds for many years. And then a few years ago, at the same time, we both ended up working on crypto matters when they were quite nascent, really. And we started that early on, setting up crypto funds in Cayman. Now, I think a lot of what we talk about is going to be based on how you set up a hedge fund, because there's a good sort of set of precedents there and it all works. But before we go on to talk about then the additional and the extras that you need to think about crypto, tell me more about Cayman and crypto funds.
Yeah, you're right, Claire. I think that what's important is that, fundamentally, these are registered hedge funds or mutual funds in the Cayman Islands, or they could equally, if they're closed-ended, they could be registered under the Private Funds Act. But either way, they're going to be registered entities in the Cayman Islands. We both got into this space about 8 years ago with our first crypto fund that was just buying. Obviously, now things are significantly more sophisticated. The market has evolved hugely. So with a crypto fund, you're looking at all of the standard or relatively standard considerations that you would look at for mainstream asset class, although we're all in the alternative asset space here, but still relatively mainstream. In addition to that, you've got the crypto sleeve of considerations that we're going to run through today on top of the usual stuff.
Okay, and on that crypto sleeve, which I think is a rather nice way of putting it, I like that. How about, can we start, there are a few things to think about, but first of all, shall we start about thinking about the risk factors? Now, there is a view, sometimes rightly, sometimes wrongly held, that crypto is inherently more risky and inherently more prone to money laundering. This, of course, has to be dealt with in the offering memorandum for the fund so that all investors know about the risks that are inherent. And not only is that sort of information which investors do need to have, it also protects the fund manager as well. So it works for all parties to have a good set of risk warnings and everybody know what they're doing. Can you talk a bit more about the kind of risk warnings that you and I have drafted and looked at for some of the Cayman crypto funds we've worked on together?
Sure, you're right. Disclosure is key. And no one should be afraid of sort of disclosures. They are a good thing. It's important to tell your investors everything in terms of what you're going to be doing with this fund. You're not going to be giving away the secret sauce, the proprietary trading information, but you are going to be telling investors everything you're going to be doing with them, how potentially it could be lost, and everything associated with the fund going up or the fund going down. That's standard with any fund. But there are crypto specifics that Claire's mentioned that we need to go through. So fundamentally, we need to disclose away the legality of the digital assets. We know that this is an unregulated market, and we need to disclose the fact that we're buying assets that are unregulated. We're buying them on exchanges which are fundamentally unregulated. We also know that there can be liquidity issues. We're not going to be disclosing, as I mentioned, the investment strategy ins and outs, but we are certainly going to be saying what we're trading, where we're trading, and what we're trading.
Yeah, and I think then there are the other things which are additional and only crypto. So it's things like staking, mining issues going wrong, inevitably the sort of the fear of theft and whether an asset is itself a proper property, if that makes it right, which it is now in the UK, but it isn't everywhere.
No, and everything that you're doing in terms of, whatever your policy is on custody, valuations, insurance, coin provenance, everything is disclosable, both as this is what we're doing and then the corresponding risk factor.
Well, can I pick you up there on the issue you just mentioned, in particular, if we could just talk a bit about custody. Obviously, a fund needs to have a custodian, and we spend quite a bit of time in the UK thinking about how a custodian custodies within wallets and the UK money laundering regulations on wallet providers, when they're in the UK. It's an EU thing really, but we're working in the UK. Can you tell me a bit more about the custody issues for a crypto fund and how they are solved? Because it's fine for us to sit here and get everybody worried, but actually we're in the job of providing solutions. So what are the issues? How do we solve them?
Sure. So custody has evolved a lot over the last 8 years. 8 years ago, we set up the fund that was trading Bitcoin, and the phrase self-custody was the one that, because no one was providing custodial services. The regulated banks couldn't touch it, and no one else was in the space. Over time, crypto custodians have evolved,
and they've come and gone as well, haven't they? Actually, not everybody who started is still there.
They've been bought by other shops, or they've gone out of business for various reasons. But that's all part of the evolution of this market.
Yeah, very much so.
But I think that again, fundamentally, it's about what are you doing with security and how are you trading your assets. You can't just leave them on an exchange. Exchange can be hacked. We all know that, depending on which exchanges you're on, etc. So it's all about setting out just what your trading strategy is. That's the first thing to do. So
yep, and you're absolutely right. Yeah, the trading itself is. I mean, I know the one custodian we do a lot of work with. You can go within a walled garden to trade, so you've got an extra layer of security. Trading itself is still an area of concern and potential theft.
Yeah, I think that few people now are involved in self custody. That the exchanges, again, I keep using the word fundamentally and sophisticated, but fundamentally, the exchanges are now more sophisticated and many offer custodial solutions too. You've now got US national federal banks that are licensed to take on crypto custody. So there's been a huge evolution. You look at Bitco, Coinbase Custody, Digivault, Gemini. These are all giant digital custodians in the space now. Very, very sophisticated offerings.
Yeah.
So really, there's no excuse anymore in terms of, I'm just going to self-custody. It doesn't work, and investors are not going to run with that. They
put it this way. Would you invest in a crypto fund that was self-custodying? I wouldn't.
I think that plenty of people have, because the investors in the space
but now I think in the past, yes, but when there weren't solutions, and it was you could argue that it was the safest option. Now, I think that third party, an extra pair of eyes, a third party, provided that custodian is secure. So, for example, Gemini is regulated in the UK. Copper is regulated. I find it hard to believe that you can do self-custodying, which is as strong as those guys.
It's going to be the first red flag that comes up on a DDQ from an investor. Is kind of like
it is, yeah.
And if the answer is, I've got an account with Anchorage, great, that's it. You've ticked that box, move on. If you say no, it's all self-custody, it's one eyebrow up. It's like, well, why are you doing that? And I can't think of a single reason that would justify self-custody for a fund these days.
Yeah, exactly. Nowadays, yeah. The second thing you mentioned, actually, you talk about custody and then valuations, insurance, a couple of others. Should we talk a bit more now about valuations? Because one of the critical things to get right in a fund offering memorandum is what the fees are and how are they calculated. And you can't calculate the fees without calculating the NAV. Mm-hmm. Now, under AIFMD, the UK AIFMD included, the investment manager has to be responsible for this, although inevitably the administrator is the person who helps a great deal. Can we talk a bit about whether our crypto assets, and I know that's a sort of a huge sort of covering term, Are they hard to value? Are some hard to value? How do you and I find a solution for people on the valuations?
Yeah, look, I think that it's just down to disclosures and also the risk.
Pick your counterparts as well.
Yeah, so clearly that there's going to be a risk factor on arbitrage. Different exchanges pricing things differently. These are all unregulated exchanges. I think that will change everything. But right now they are unregulated, so there can be, as we've seen, wide movements of pricings.
Yeah, and that's also another one for the risk factors, isn't it?
So for reasons unknown, all of that falls into your valuation policies, and you'll work with both your onshore lawyer, your auditors, in order to work out what and how your valuation strategy is going to operate. Just make sure that you use it and you apply it, and you never away from it.
Because it's not as if in the hedge or PE world, it's not as if the fund world doesn't understand hard to value, doesn't understand fast moving dynamic markets. It's just a question of making sure you've got the wording right, you've got counterparts and functionaries who can do it, and you do actually say what you're going to do, so you haven't got investors coming back later saying that there was something fraudulent.
No, with this asset class, although there are some unique features to it, at the end of the day, this is still an investment fund, and all the usual things that occur in an investment fund will occur with a crypto fund.
Yeah, and there's so many sort of established ways of gaining prices that, sometimes it's, I find it's quite useful just to refer back to some of the ISDA wording and use that. Yeah.
Every have a liquidity risk factor. So will a crypto fund. So it's nothing to be particularly worried about. And if you're an investor,
you've just got to get it right, though, haven't you?
You've already looked at it. You know what that should be saying, making sure that that's the policy that's being adopted. Yeah.
And then insurance, Ian, that was one of the other points that you mentioned.
Yeah.
It's been an interesting one, but there have, again, huge developments in the world of the insurance that's available for people.
Journey, and obviously at the end of the day, the market has needed the global insurance providers to kind of get interested in this space, and they have done that, which is why it's evolved. It started off with the concept again of self-custody. So the manager was self-custody, right? Okay. The exchanges with self-custody, or it was we're balance sheet protected. Well, we heard all that over Lehman.
Well, yeah, exactly.
Where it's gone now, look, that there are some really good options, but again, it depends on the pricing for your crypto insurance is going to depend on what your strategy is and which exchanges you're trading on.
Yeah, how good your counterparts are, how good the whole model is, who are the functionaries you've got in place. Yeah,
you're on Binance, Coinbase, Gemini. These are all exchanges that carry insurance. So they only have insurance because they have outstanding cybersecurity protections.
So in other words, do due diligence on who you will have as your counterparts, and that due diligence needs to include what their insurance is.
Yeah, you'll talk to Copper and say, okay, so tell me how my assets are going to be insured with you and for what, because that's part and parcel of the disclosures you're going to make in your offering document.
Yeah,
it's going to tell you the insurance providers. Aon roughly covers about 50% of the insurance market for crypto. So when you're chatting with them, you're going to be telling them which exchanges you're trading on, which coins you intend to buy, etc., what coin provenance software you're going to use. They are then going to price up the insurance. Now, it may be that you don't want insurance, that you feel that it's not of value because of the exchanges you're trading on. That's fine. Tell your investors that.
Yeah, you've got to disclose that. Yeah. Yeah, investors need to know that it's not there. It would be an act of omission not to tell them. Yeah.
And then it's a question of what is being insured and how. Is it in specie insurance or not? So we can get in the ins and outs of all that kind of stuff, but you're not going to be insuring for the values going up or down. You're really going to insuring for the cyber hacks at the end.
For safety. Yeah.
It frankly, in my view, it's important to have. In addition to what the exchange covers, you've got effectively you have double insurance if you're trading on the main exchanges.
And well, just where we're talking about cyber hacks and so on, one other question, which you and I both get asked all the time. What about a bank account?
Yeah, again, it's something which was at the beginning of this market very, very challenging. Well, actually, at the beginning, it wasn't so challenging. A lot of people were offering bank accounts. Then, uh,
that was the problem. There were too many of them, and then
then they stopped.
And then the bad boys disappeared, and
ICO boom. That's when everyone ran for cover in the banking world. There are providers out there that provide insurance, that they're specialists.
Bank accounts as well. Yeah.
Yeah, absolutely. Now, often it will depend who you are and just how much you have as to whether they're interested in you or not. But there are solutions around banking.
Yeah, definitely. So I think then, if we could just come on to my last question for you in our crypto questions, and they're kind of related, really. How do you deal with, or how do you advise people deal with coin provenance? And that ties in with in-specie subscriptions, because it's really not unusual with a crypto fund to have a non-fiat but an in-specie subscription.
Look, it's my favorite question, and it's something.
Do you know what? And nobody can see you apart from me, but you're there, sort of, with your head in your hands.
Yeah, because it's not for me, because I really like this, and I push it hard, but I get pushback from people on it.
You're so right. You know, same thing here. You push, because you've got to know all the way through, haven't you? The whole life cycle's got to be open, disclosed, transparent. And
look, right now, do you want to be buying? Do you want to be setting up a fund where you are buying coins that are linked directly or indirectly to the Kremlin? No, you do not. So it's about coin provenance. You can follow the chain. You can find out where they were mined, who's held them, and the coin provenance software that's out there with the likes of CoinPath, Global Ledger, Chainalysis, Coinbase Analytics. There's a whole industry. They can rate the coins for you. It mitigates your risk.
And they could do it. So, I mean, I was involved in something where Chainalysis had just popped something up way back. One person a few years ago, is something as simple as maybe 20 years ago, they were late on their poll tax or something. It's so sophisticated now. So yeah, there's no excuse really for playing dumb when we all know that, this is the bad boys send the money for things like child pornography, the North Korean missile program, the Kremlin. It's, nobody wants to be part of that.
Well, you want to make sure that you're not buying that stuff. And,
exactly. So don't. Yeah. So
themselves, the main exchanges do a really good job. But again, they're deploying such software. But you as a manager, my view is that you should be ensuring that you are using coin provenance. The investors' monies are not at risk with such coins or such coins being purchased by you. That ultimately could, if they have been stolen, if they are linked elsewhere, can suddenly become void. At the end of the day, what it is, in addition to the moral sort of factors and issues that I feel very strongly about, there is a risk that it will turn to dust. So you have a fiduciary as well as a legal obligation to ensure that what's being purchased is worth what it is.
Yeah, where it comes from, what it is, all its characteristics. Yep. And that's not just in what you're purchasing. It's also if you're a fund that takes in specie subscriptions as well, isn't it?
On the specie piece, at the beginning of the market, we saw some of the fund admins, take on in specie subscriptions, but mainly from the principals of the funds. It was how the principals would get their assets into the fund so others could share.
Well, it's often own money trading, built it up. And opened a fund. Taking it from other people is a slightly different line of entry.
And coin provenance didn't really exist in those days either. So it was very much looking in the whites of the eyes of somebody and sort of saying, okay, give me enhanced due diligence on yourself, your source of wealth, all that kind of stuff. Obviously now it's significantly more expensive, sophisticated with the software that's in place. And on expense, it doesn't cost the earth. So it's just something that should be commonplace and everyone use it as an industry standard. In specie, subscriptions are still an issue. A lot of the main admins won't sort of do that, or if they do, there's a price tag.
Yeah, there's a cost to it. Yeah.
And that's, well, who pays that? Should it be the investor that pays? Probably. Should it be the manager? It could be. Is it the fund? There could be situations where it's worthy of the fund to pay for the enhanced cost for the diligence over an in-specie subscription. So it's all on a case-by-case basis.
And I think also if there is that cost and it's more than material and it's going to the fund and it's being paid by all investors, whereas if you only have a couple who are making in specie, again, going back to what we said at the beginning, I think that's also a matter for disclosure, isn't it?
Yeah, it totally is.
It'll turn up in the accounting, but get it out there before anybody comes in.
Yeah, it's a conversation you need to have with your admin and your auditor to make sure that people are comfortable that this is going to be happening, and to stress test the policies and procedures that are in at the fund administrator to ensure that this can happen. Or indeed, if they have a blanket ban, no, we can't. We won't be doing that for you.
Yeah, and it does, and I know that when you and I put fee proposals together for people, we do say it's going to actually cost legally. It's going to be a little bit more if it's in specie because of the work involved. But it works for some people. It doesn't for others. It's very much a commercial decision that everybody makes, depending on their own commerciality.
From a marketing perspective, it always looks kind of sexy. Hey, we'll take subscriptions in specie. When it actually comes down to it, most of the investors want to hold on to the crypto that they've got, and they're not looking to really settle it into a fund. Some may, but they're looking to spread their risk. They're investing in a fund to spread the risk, and as an overall portfolio, maintain the crypto that they've got.
Yeah. It's like other types of commodity fund in a way, isn't it? Which I always think crypto is quite similar to that. Do you want to liquidate your commodity positions to go into cash, to go into a fund? Or do you want to keep your positions and also make your own investment in cash? So, yeah. Ian, it has been so lovely to catch up with you. You're not looking any older. You're fully dressed.
Dressed, yeah. And now that I have 2 babies, the last 2 years have been very interesting for everybody.
Well, look, before we say goodbye to everybody, can you quickly tell people how they can get in contact with you and find out more about what you do, what Intertrust Law does, and about sort of crypto in Cayman in general?
Sure. So you can reach me on our website, which is www.intertrustlaw.com. You can reach me on ian.gobin@intertrustlaw.com as well. Feel free to reach out if you have any sort of comments or you want to explore things further from a Cayman and BVI perspective in respect of the setting up a crypto asset fund. Please let me know.
Perfect. And Ian, next time you're in Europe, away from Cayman, let me know, and I'll come and see you and your wife. Lucky lady.
As always, thanks very much.
Ian, thank you very much. And just for Cummings Pepperdine, it's cummingspepperdine.com. And Ian and I both look forward to speaking to you. Thank you very much for listening. And goodbye.
Boom.